Income, both short-term and long-term, is a fundamental aspect of financial stability and growth. Whether you're an individual seeking financial independence, a business striving for profitability, or an investor aiming to build wealth, understanding the nuances of short-term and long-term income is crucial. Both play vital roles in shaping your financial future, but they serve different purposes and require distinct strategies to maximize their benefits. This article explores the differences between short-term and long-term income, the various sources of each, and how to balance them to achieve financial goals. What is short-term income? Short-term income refers to earnings that are typically received in a relatively brief period, usually within a year or less. This type of income is often generated from activities or investments that provide immediate returns or payments. It is commonly used to cover day-to-day expenses and short-term financial obligations. Common sources of short-term income: wages and salaries. The most common source of short-term income for individuals is employment. Wages or salaries are typically paid weekly, bi-weekly, or monthly, and are used to cover regular living expenses such as rent, utilities, and groceries. Freelancing or gig work. The rise of the gig economy has opened up various opportunities for individuals to earn short-term income through freelance work or part-time gigs. Platforms like Upwork, Fiverr, Uber, and DoorDash allow individuals to take on temporary projects or provide services for a fee. This type of income is often flexible and can be earned quickly, making it ideal for supplementing regular income. Rental income. For individuals who own property, rental income can be a significant source of short-term income. While real estate is generally considered a long-term investment, rental income is often collected monthly and can provide a steady stream of cash flow. Dividends from stocks. Some investors earn short-term income from dividends paid by stocks. Dividends are a portion of a company's profits distributed to shareholders, usually on a quarterly basis. While dividend income can be part of a long-term investment strategy, it can also provide immediate financial benefits. Interest from savings accounts or bonds. Interest income from savings accounts, certificates of deposit, CDs, or bonds is another form of short-term income. Although interest rates on savings accounts are typically low, they can still provide a modest return on cash held in these accounts. Selling goods or services. Entrepreneurs or side hustlers who sell products or services can generate short-term income. Whether it's an online business, a brick-and-mortar store, or selling items on platforms like eBay or Etsy, this income is realized relatively quickly after a sale is made. Benefits of short-term income. 1. Immediate cash flow. Short-term income is essential for managing day-to-day living expenses, emergencies, or unexpected financial needs. 2. Flexibility. Short-term income streams, such as gig work or freelancing, often provide flexibility in terms of work hours and project choices. 3. Diversification. Having multiple sources of short-term income can provide financial security and reduce reliance on a single paycheck. Drawbacks of short-term income. 1. Limited growth potential. Short-term income is typically used for immediate expenses, leaving little room for reinvestment or growth. 2. Tax implications. Depending on the source, short-term income can be subject to higher tax rates, especially if it is classified as earned income. 3. Income insecurity. Some forms of short-term income, like freelance work, can be unpredictable, making it challenging to rely on them for long-term financial planning. What is long-term income? Long-term income refers to earnings that are accrued over a more extended period, often beyond 1 year, and typically involve investments or strategies designed for growth and wealth accumulation. This type of income is often reinvested or saved, with the goal of securing future financial stability or funding retirement. Common sources of long-term income: investments in stocks. Investing in stocks is one of the most common ways to generate long-term income. While stock prices can fluctuate in the short term, the long-term growth potential of equities often outpaces other types of investments. Investors who hold stocks for many years can benefit from both capital appreciation and dividends. Real estate investments. Real estate is another popular source of long-term income. Property values tend to increase over time, providing long-term capital gains. Additionally, rental properties can provide both short-term cash flow, through rental income, and long-term wealth accumulation, through property appreciation. Retirement accounts, 401k, IRA. Contributions to retirement accounts like a 401k or IRA are a form of long-term income planning. These accounts grow over time through contributions and investment returns, and they are typically used to fund retirement. Withdrawals are often taken later in life, making them a long-term financial strategy. Bonds and fixed income investments. Bonds, particularly long-term bonds, provide a stable source of long-term income. Bondholders receive regular interest payments over the life of the bond and the principal back at maturity. While bonds are considered lower risk than stocks, they also offer lower returns, making them a conservative option for long-term income. Business ownership. Owning a business can generate long-term income, especially if the business is successful and grows over time. Entrepreneurs who build a company can reap long-term rewards through profits, reinvestment, or the eventual sale of the business for a substantial profit. Pensions or annuities. For those with access to pension plans or annuities, these financial instruments provide a guaranteed stream of long-term income, usually after retirement. Pensions are often employer-funded, while annuities are purchased as part of a retirement plan. Benefits of long-term income. 1. Wealth accumulation. Long-term income streams, especially from investments like stocks and real estate, have the potential for significant capital appreciation, leading to wealth accumulation over time. 2. Financial security. Long-term income provides financial security for the future, particularly in retirement or during economic downturns. 3. Tax efficiency. Many long-term income sources, such as capital gains from investments, are taxed at lower rates than short-term income, providing a tax advantage. Drawbacks of long-term income. 1. Delayed gratification. Long-term income strategies often require patience, as the financial rewards may not be realized for many years. 2. Risk exposure. Some long-term investments, such as stocks or real estate, can be volatile in the short term, exposing investors to potential losses. 3. Illiquidity. Certain long-term investments, like real estate or retirement accounts, can be difficult to access quickly in case of an emergency, limiting liquidity. Balancing short-term and long-term income. Achieving financial success requires a balance between short-term and long-term income. While short-term income is necessary for immediate needs and expenses, long-term income is essential for building wealth and securing your financial future. Here are some strategies for balancing both. Budgeting and saving. Create a budget that covers your short-term expenses while setting aside a portion of your short-term income for long-term savings or investments. This ensures that you're meeting your current financial obligations while also planning for the future. Diversifying income streams. Diversification is key to financial stability. Having multiple sources of both short-term and long-term income can reduce financial risk and provide security during economic downturns. Reinvesting short-term gains. If you have surplus short-term income, consider reinvesting it in long-term assets, such as stocks or retirement accounts, to grow your wealth over time. Managing debt. Use short-term income to manage and pay off high-interest debt, which can free up more funds for long-term investments and savings. Reducing debt also increases your financial flexibility and security. Planning for retirement. Contribute regularly to retirement accounts and long-term investments to ensure that you have a reliable income source in your later years. Even small contributions can grow significantly over time through the power of compound interest. Conclusion. The importance of integrating short-term and long-term income. Both short-term and long-term income play vital roles in achieving financial stability and growth. Short-term income allows you to cover immediate expenses and maintain a stable cash flow, while long-term income strategies are essential for building wealth and ensuring financial security in the future. By balancing both, diversifying income streams, and making strategic financial decisions, individuals and businesses can create a solid foundation for long-term success. Whether through careful budgeting, investing, or debt management, Understanding how to optimize both types of income is key to navigating today's complex financial landscape.